Good morning, everyone. Welcome to the third webinar in the series of five. Um, in this webinar, we're going to be discussing post-retirement products, and that includes living annuities. And I'm joined by Clive Lazar from Just as well, who's going to be introducing the life annuity and a blended solution for everyone to access. So just a little bit to touch on the agenda for today, I'm going to discuss what a living annuity is and also how living annuities are taxed and what happens at death. And then also a pressing question that we often get is how to make your income, if you do decide to invest in a living annuity, how do you actually make your income last through retirement? Obviously, because it's not a guaranteed product. So I'm going to touch on that a little bit as well. And then just before I know I spoke about this in my first presentation, but just to reiterate, generally we're working for a period of 40 years, and these are years that we assume to be saving a portion of our salary or income every month. And we generally start at age 25, and we plan to retire by age 65, which makes up the 40 years. And the income that we save for retirement is meant to last us generally between 20 to 30 years during retirement. And this is the thinking behind most of the concepts that's discussed in the presentation. So just to jump straight into it, what is a living annuity? Just a brief overview. Living annuity is generally access through pre-retirement products, and these are your normal retirement annuities, your pension, provident funds, and also preservation funds. And the purpose of the product is to provide you with an income when you decide to retire. One feature of the product is that you can select the underlying investments. You can decide which funds to invest in within the living annuity, and you're also not restricted in terms of Regulation 28. So that means that you can go 100%. You can expose your investment 100% to offshore assets if you want to do that. A living annuity also gives you the option to select an income level, and that varies between 2.5 to 17.5%, and that can be changed once a year, depending on your income needs. You can also decide on the frequency of payments, and those frequency can be either monthly, quarterly, semi-annually, or annually, and that can also be changed once a year on your anniversary date. And with most of these living annuities, one feature that's offered, or another feature to it, is that you can leave the full balance of the investment, whatever's left over when the investor passes on, that can be left to beneficiaries. And I'll touch a little bit more on that in the next couple of slides. So, how a living annuity is taxed and what happens at death. So, with living annuities, similar to normal unit trusts, we have investment returns, right? And these returns are made up of three components, which are changes in unit prices or capital gains. There's dividends and there's interest as well. But the difference between the living annuity and a normal standalone unit trust is that all three of these components are tax free within the living annuity. So you don't need to pay capital gains tax, dividend withholding, or interest withholding tax. The product isn't completely tax free though. So the products, sorry about that, just mute myself. So the product isn't completely tax free. The income that you receive through the product is taxable. Um, and SARS sees this essentially as a source of income, and therefore you tax according to tax tables that they release, or basically a marginal tax rate. And there's one of two ways that you can be taxed within the product, because you can be taxed according to the marginal tax rate, but because it's a standalone product and you can have multiple living annuities from different companies, you can essentially set the tax rate that you want to achieve. So if you want to be taxed higher than your normal tax rate to account for a different income that you're receiving, you can do that as well. You can also, if you decide to set it at a lower rate, you can do that as well, just provided that we obviously receive the correct documents for that. And then what happens at death? So, like I said, at death, you can leave the balance of your investments for your nominated beneficiaries. Um, and the beneficiary that you nominate can be a natural person or a legal entity, or it can be done as a combination because you can allocate a portion to each beneficiary. You can also elect to have the money paid out to your estate. And one thing to keep in mind is that any portion your beneficiary receives is not taxed in their name, but is taxed in the investor's name. So we say that it's taxed at the hands of the deceased. And when it comes to the options, right? Um, each beneficiary has a different option. So each beneficiary has one of three options. The first is to either take the full portion in cash. You can transfer the full portion to a living annuity. This is if the beneficiary is a natural person, or you can do a combination. So you can take a cash portion, or you can take and transfer the balance through to another living annuity. And one thing to note is that this is not age specific. So even if the your beneficiary is below age 55 or 60 or 65, or whatever the retirement age is to access the living annuity, it's not age dependent. So if your beneficiary is a legal entity, there's only one option, which is to receive the full portion as a cash lump sum. And then if you elect to pay this money to your estate, it's also just a cash portion. We obviously just pay the balance out in cash. But one thing to note is that the living annuity isn't subject to any estate duty. And that's not dependent on whether the portion is paid to the estate or not. So even if it's paid to the estate, no estate duty will be applicable to the portion. Um, but executive fees will apply if it is paid to the estate. So if it's paid to a natural person or legal entity, then executive fees and estate duty won't apply. But if it's paid to your estate, then executive fees will apply to that portion. And then quickly, just to touch on how we think about going, how we think you should go about trying to make your income last, or what you should do. We've come up with three different objectives that you should think about. It's an important question, obviously, because like I said, your income isn't guaranteed. It's linked to an investment which is based on the performance of the underlying funds. So it's different from a life annuity where your income is guaranteed for over a period. So three things to think about. The one is to plan for a long lifespan, right? The second is to structure your retirement portfolios for growth. And then the third is to make sure you draw a sustainable income. I'm going to touch on each of these in the next couple of slides. So plan for a long lifespan. As you know, with improvements to our medical industry comes improvements to treating illnesses and diseases. And these illnesses and diseases they previously increased our mortality rate. And this means that we have more individuals that are living much longer lives, and our life expectancies are increasing. And this is going to continue to increase as long as there's improvements to our health and our medical industries. And it also means that we need to rethink how long we need a retirement income for. And if you look at table one, which I'll show on the next slide, it shows how many years of income to plan for to be either 50% or 90% sure that you're not going to be outliving your income stream. So as an example, if we look at a male age 65, right? The table shows that in order to be 50% sure that this male won't outlive his income, you should be planning for at least 16 years of income. And at this point, there's still a 50% chance that he's going to outlive, that he's still going to be alive. And he'll need, essentially, that he'll need more than what he accounted for. On the other hand, if he wants to be 90% sure, he needs to plan at least 28 years of income. At that point, there's about a 10% chance that he's still going to be alive and need more income than what he planned for. And of course, we're all different in the situation, but if you want to have a reasonable amount of certainty that you're going to be achieving your income over the projected period of time, you need to plan for at least 30 years in retirement. So that's only half of the story. In each of these years, you're going to need to increase your income with inflation to maintain your income in real terms. And inflation basically determines the level of income required in each of the 30 years and also determines um, the nominal return that's required for income to be sustainable during this time. We only while we have so we've become quite used to low inflation levels and reasonable stable inflationary environment, but it hasn't been the case and might not be the case in future. We need to realize that our portfolios need to be resistant when it comes to inflation in order to be able to generate the necessary returns we need in order for our income to last. The second objective is to structure retirement portfolios for growth. A lot of the time, retirees kind of shy away from growth assets because of high levels of risk associated to these kinds of investments. And most of us forget that we plan for between 20 to 30 years of retirement, and that's still considered long term. And if you look at table 2 on the next slide, it's going to show the level of real return we need for different investment horizons and income requirements. And what you'll see on the table is that at higher levels of real return, you need to take on significant investment risk to achieve the real returns necessary. So, as an example, if your starting income is, let's say, 4% of your current capital, um, increasing each year, so this income is going to be increasing each year uh, with inflation, and you need 30 years of income, and you need to achieve at least 2.2% per. So you basically need to achieve at least 2.2% per annum in real returns. If your starting income requirements is, for example, 8% of capital, and your required real return increases to 8.2%. At higher levels of required return, you're going to need to take on significant investment risk to stand any chance of achieving the target returns. And that's quite scary to think of. And then the last objective is to make sure that you draw sustainable income. When it comes to your investment risk, it obviously affects the returns that we achieve. And sometimes our portfolio return is lower than what's required in order to make sure that we're not eating into our capital with our income. And if we're unlucky enough, it may be during times when the market's in a downturn. So the graph that I'm going to show on the next slide, it shows how the volatility of returns affect the sustainability of income over a 30-year period. And in the graph, we made a couple of assumptions, and the assumptions are that the portfolio return is 10% per annum, inflation 6%, and the starting income is 4% of capital, and that increases every year with inflation. So what the graph shows us is that basically at 0% volatility, there's 100% chance of sustainability, and you would then get the expected portfolio return of 10% per year. Now, as the volatility increases, the chances of sustainability reduces along with the personal return or returns that you can expect during the time. To put it into context, the Allan Balance Fund sat near about 10% volatility since inception from 1999. And at that level of volatility, the average client return would then be approximately 9.4% per annum, or about 0.6% lower than the portfolio's expected return of 10% per annum. So the graph shows that taking this volatility, there's only then a 72% probability of real income being maintained over a 30-year period. And this shows that even if a portfolio can achieve the required level of return over time, once volatility and drawdowns have been accounted for, you may not get the same or the level of return that you require or that you need to be able to sustain your income during the time. Accounting for these risks, it becomes clear that the achievable real return and starting income levels are more limited than what was shown in table 2. So basically, to summarize it, how do we go about managing the risks I spoke about above? The key is to make sure that we invest for real returns, which means earning a return above inflation, and to make sure that we actively manage any downside risk our portfolio is exposed to. And what that basically means is that we need to have a significant portion in growth assets to increase our chances of achieving the returns we need. One other thing that's important is to make sure we don't react to short-term market movements, because this stunts any recovery the fund experiences or the portfolio we invest in experiences. And we did quite a bit of research and we found that investors should have at least a minimum of 50% in growth assets, for example, equities, in order to generate the return that we need. Another thing that can also be done is you can expose your investment to guaranteed annuities, which Clive is going to touch on. Um, and that's living annuities in summary. Clive, you can just go ahead and share your screen. Clive is going to touch on life annuities and blended solutions for us.
Right. Can you see the screen?
Yeah, we can. I can see it.
Okay. Thanks, Shauib. Good morning, everybody. My name is Clive Lazar. I'm the regional manager for Just Retirement Life here in Johannesburg. And I've been asked to chat to you about our with-profit annuity solution, which can be purchased either on a standalone basis directly from us, or alternatively, it can be purchased as an investment portfolio inside various living annuity platforms. Our flagship product is called Julie, which is standing for Just Lifetime Income, which is a guaranteed life annuity. Before I go into explaining the product, I'd just like to spend some time sharing a little bit of information about our company. We're not a household name in South Africa, but we certainly are well known in the UK market, where we are a listed financial services business on the UK FTSE, one of the top 250 companies, and we specialize in building retirement income solutions. That's all we do. We don't do investments and we don't do administration. We entered the South African market in 2016, and we are fully licensed with the local regulator, the prudential regulator. We hold the necessary capital to back the policies or the liabilities we issue. And we've established partners with a number of the leading asset managers and retirement fund administrators. As I said, we just build retirement income solutions. We certainly, from a financial strength perspective, have the backing. We are a wholly owned subsidiary of the Just PLC group. And just to give you some sort of comfort in terms of the size, the Just PLC group has over 600,000 policyholders with over 40 billion rand in asset size. As at the end of 2019, from a solvency perspective, we had almost double, just over 200% of the required solvency capital under management in terms of the regulatory requirements. And in terms of our own risk and solvency assessment, we hold more than sufficient capital to back not only what the regulator requires, but also for the 1 in 200 stress events, should there be some kind of event like what's happened this year, for example, COVID, where we hold additional capital to back those kind of stress test events. Any further information on our company, together with our financial statements, we're more than happy to make it available to any client or financial services group who needs the information. And just to give you some comfort, we have been due diligence by a number of leading asset managers who have done the due diligence to gain comfort in our product, in our financial resources, in our processes before they made it available as a solution on their platform. Before I go into our flagship product, which is the Just Lifetime Income Guaranteed Life Annuity, I'd like to just spend some time talking about guaranteed life annuities in South Africa, leading up to to the end of 1999, 2000, the majority of retirees were purchasing guaranteed life annuities. And then over the last 20 years, we've seen a dramatic shift towards living annuities, which have become much more popular. Per the CISA stats, over 90% of retirees go into living annuities. And recently, we've started to see clients, retirees becoming more interested in the guaranteed life annuities. So it certainly is starting to gain a bit more popularity. If we look at the types of guaranteed life annuities that can be purchased, we talk about a level annuity. I mean, that's a straightforward annuity that doesn't increase on an annual basis. So it will give you the highest starting income, but won't protect you against inflation. We've got fixed escalation annuities that we also manufacture. The very popular or common one is a 5% fixed escalation annuity. And clients like that because it provides a fixed increase each year. For example, a fixed increase of 5%. Of course, one of the problems with that is if inflation increases and goes back to some of the high levels it was many years ago, then obviously that is not going to keep pace with inflation. But currently at levels of 4-5%, a 5% fixed escalation annuity is quite attractive. And then, of course, we have an inflation-linked annuity. So whatever inflation is, whatever inflation prints, that would be the increase for the client. Now, those three types of products, level, fixed, and inflation-linked, are what we call non-profit annuities. And essentially, we at Just are holding nominal bonds and structured deposits to back the policies that we issue for those clients. We call those non-profit. One other thing that differentiates our non-profit annuities from the rest of the market, because remember, it's a commodity where really at the end of the day, it's all about price, about the starting income. The highest starting income is the product that the advisor and the client should select. Of course, other than the financial strength, but going back to the differentiation is that we do underwriting at retirement. So we believe that you should treat customers fairly, and people who are sick shouldn't be subsidizing those who are healthy, and vice versa. The wealthy shouldn't subsidize the poor. So we actually want to do an underwriting assessment of each retiree when we issue a non-profit annuity before we can actually finalize and issue a firm executable quote. The next guaranteed life annuity that is available in the market is a with profit annuity, and that's our flagship product and the one that we believe provides best value for money in terms of a guaranteed life annuity, and also endorsed by a number of our partners as the best value for money. As I'll go on to explain, a with-profit annuity is to a certain extent an investment-driven product, because the components that make up the product is a combination of nominal bonds and structured deposits, as well as an investment component, where there's an investment in a specific portfolio which the retiree chooses. And then the last and sort of more recent development in the market is what we call the blended solution, often referred to as the hybrid. And essentially, that's a combination of your guaranteed life annuity with your living annuity. And as I'll go on to explain later in the presentation, actually, it kind of gives you the best of both worlds. So it's not to say the living annuity is the best answer, nor is the guaranteed life annuity, but when you actually blend, you often get the most optimum outcome on a sort of retirement income frontier. But if we just look now at the with profit annuity, our flagship product, the Just Lifetime Income with Profit, and we delve into how that product works, which, as I said at the beginning, can be purchased on a standalone basis. And I'll then cover why we think this is the suitable product for covering a client's essential expenses at retirement, because it removes the longevity risk, which is transferred to the insurer. It also transfers the investment risk, because no matter what happens in the market, the client will continue to get the guaranteed income. It's expected to go up by inflation, and it takes away the behavioral risk of a living annuity, where a client could potentially draw down too much or draw down too little both sides of that equation. So moving on then to just the basic principles of this guaranteed life annuity. Guaranteed life annuities essentially are a contract between a retiree and an insurer, such that the retiree provides or brings his lump sum capital to the insurer, and in return, the insurer promises to pay a guaranteed income to that retiree for the rest of their life. And the retiree essentially is prepared to pay that capital because they don't know how long they're going to live. On the graph here, you see that the vertical axis is income, and on the horizontal axis is life expectancy. And we believe, based on our actuarial assumptions, that on average, a male who retires at 65 should live to 82. That's 17 years, and a female should live to 87. That's 22 years. And obviously, well, not obviously, but we do believe that females live longer than males. And a 65-year-old male is prepared to say, here's my lump sum capital, because they don't know how long they're going to live, but should they live beyond their life expectancy, they'll continue to receive their income. So we've priced that a life annuity. Essentially, if you take R1 million of capital, less the insurance premium, price it to the life expectancy. And that's how we calculate the annuity rate. And no matter how long the retiree lives, they'll continue to receive the income. The blue line would be a representative of a level annuity, what I've spoken about. The green line would be representation of a fixed escalation or an inflation-linked annuity, starting off lower but going up by a fixed percentage. And then the flagship product that I'm going to speak to you about now is our Just Lifetime Income with Profit annuity, which in general you'll find will have a higher starting income than the fixed escalation annuity, but the increases are not guaranteed. And that's what I want to speak to you about now. So the principles behind a life annuity is you do get pooling. You get pooling of risk because people who die before their life expectancy subsidize those that live beyond their life expectancy. And that's effectively how we price the annuity. So it's you don't have to self-insure like in a living annuity where you take on all the risk yourself, the longevity risk of how long you're going to live. The insurer takes that longevity risk, and as a result of that, is able to give you a very attractive starting income. If we just delve into the workings of a with-profit annuity, the retiree would give us their capital, let's say R1 million. We would price that annuity. So let's assume he's single, he's a male, and currently your indicative starting income or your annuity rate is around 8% for a single life male. So that would be 80,000 Rand per annum. With a with-profit annuity, as I said, there's an investment component. So we are going to be putting some of that R1 million into a reference portfolio that the retiree chooses together with the advisor. And the performance of that portfolio is going to be driving the annual pension increase that we issue to that pensioner. Importantly, per the rules of the product, increases can never be less than zero. So no matter what happens in the market, even if we have negative returns, the client's 80,000 Rand a year can never drop. And every time we do declare an increase, which I'll explain how the formula works, that increase locks in and ratchets up to a new level. So that provides a locked in, it locks in and ratchets up, as I say, to a new level. So at the very least, assuming that the retiree lives to their life expectancy of 82 and assuming there's no increases, so for the next 17 years, the investment markets deliver a negative return, at the very least, the individual will receive back 80,000 Rand a year for 17 years, which is 1,360,000 if he lives to his life expectancy for his R1 million. Of course, we do expect that over 17-year period, there is going to be increases in the investment portfolio. Now, as I mentioned before, this is an investment-driven product, so you can look at it as two buckets that we create when we receive the R1 million of capital from the retiree. The first bucket is the income bucket, and that's the bucket that we go to the market and buy nominal bonds and structured deposits in order to be able to provide that guaranteed cash flow of 80,000 Rand a year for 17 years. The second bucket is a capital or increase bucket, growth bucket, and that's where we take some of the capital and invest it in one of the portfolios that the client chooses. For example, an Allan Gray balance, a coronation balance, plus a prudential balance. We've also got the 91 Opportunities Fund. There are a number of portfolios, over 11 portfolios, which currently are available on our platform or as within our product. And so at a high level, essentially, you could say that we are splitting that capital 50-50. So 500,000 Rand going into the income bucket to secure that guaranteed income we need to pay to the retiree, and 500,000 going into the increase or growth bucket, so that that can drive the engine, that becomes the engine driver of growth and providing your annual pension increases. When we developed the product, we spoke to a number of the leading asset managers, and all of them were comfortable that over the long term, the regulation 28 portfolios that we've chosen should be able to provide investment returns that are CPR plus 4, so a real return of 4. And on that basis, the products were developed, or the product was developed to target and conservatively target increases that are inflation and above. So we also recognize that when a retiree comes to us, they might want to trade off their starting income and their future increases. So we don't box everybody into one product option. We've got 3 different product options that we make available, or calibrations. We call them, the 3 of them, called the high grow, stable grow, and high yield. Each one is literally a trade-off between starting income and future increases. The high grow will be the lowest starting income with the best chance of increases, the high yield vice versa. Almost like a seesaw. As the seesaw moves up and down, you can do that trade-off. Essentially, they're all equal value of money up to the person's life expectancy, just starting off either low or higher. But of course, if you live beyond your life expectancy, you'd want to be in the high grow, because you've got your best chances of increases, of higher increases in that option. If we then look at the annual pension increase, how that works, it's an explicit, transparent formula, so there's no hidden black box stuff. We're one of the few insurers that in our product rules, we make it clear of exactly how the increases work. And essentially, the increases are based on a 6-year average return of a particular portfolio that the client chooses. In this example, I've used the Allan Gray Balance portfolio. Those bars represent the return of the portfolio over the last 19 years. The red line with the dots on it represents the rolling 6-year average. And what we do in our product is we smooth out the volatility, or the market volatility of a multi-asset class balance portfolio by taking a 6-year average. So each year we'll drop off a year and we'll add a new year, and it's a straight average, so equal weight to each year. Add up the 6 years divided by 6, and that's your first starting point in the formula. In this example, I'm assuming that the portfolio will deliver CPI plus 4, which means if I assume CPI is 6 plus 4 is 10. We then, I'm just putting it all up so I can explain all the pieces of the formula. We then deduct our product fee, which is effectively a capital management charge of 1.1%. And then we deduct what we call the post-retirement interest rate, or the advanced investment return, which in this calibration is 2.9%. Effectively, we've advanced some of the Allan Gray balance return upfront into the starting income. So each year, before the client gets the increase, they must jump over or clear the hurdle of this 2.9%. So 2.9 plus 1.1 is 4, and effectively, if the Allan Gray balance portfolio's 6-year average return is CPI plus 4, the increase will be 6, which is in line with CPI. So conservatively, we expect, of course, it can be higher, but conservatively, we expect it to be in line with inflation. There is one other part of the formula, which is shown there as an experience adjustment. So obviously, we've set assumptions on life expectancy, and on an annual basis, we compare those assumptions to the actual mortality experience, and there can be profits or losses, but it's managed very closely, and we do use conservative assumptions. We also have Deloitte, who are independent statutory actuaries, who audit those assumptions, and generally there can be positives and negative experience adjustments, but we expect them to be very small, never more than about 0.5%. We have actually managed that pool very well, and to date, on the last 3 years, declared small positive increases. So that then boosts the annual pension increase. If we go back to my earlier proposition where we've stated that we believe that the with-profit annuity is the best value for money in the form of a guarantee in the form of a guaranteed life annuity product. Here we see that historically, if we back test over the last 15 years, then yes, the with-profit annuity has delivered better value for money in terms of income relative to a fixed escalation and inflation-linked annuity. So over the long term, we think it is the best type of guaranteed life annuity for a client. This table provides just back testing. Again, this is using the Allan Gray balanced portfolio as the reference portfolio, and even over 5 years as well as 10 years, the different calibrations have provided annual pension increases that are above inflation, considerably above inflation, especially over the last 10 years. One other point that's important is on our with-profit annuity, on the flagship product, underwriting on this product is optional. So we don't require the retiree to be underwritten, but certainly there's no downside. We don't penalize a retiree for being healthy, and it can certainly lead to what we call an uplift. It's all based on our intellectual property that is common in the UK, because in the UK market, enhanced annuities are very popular, and we've utilized that intellectual property here in the South African market to provide a much fairer way of pricing an annuity, a guaranteed life annuity. So it's basically looking at socioeconomic, lifestyle, and medical issues. And actually, to date, close to 60% of our existing policyholders have received uplifts. Many of the uplifts are small, sometimes sort of 5% and less, but depending on conditions, some of the uplifts exceed 10, 15, even as much up to 30%, once again, depending on the condition of the person's health. And one of the common fallacies that you often read about with guaranteed life annuities, which is definitely not a full truth, it's a half a truth, if you want to call it that, is that when a person buys a guaranteed life annuity, when they pass away, they lose their capital. So that's partly true, because as you know, with a guaranteed life annuity, you can purchase what we either call a guaranteed minimum payment period, or alternatively a spouse's pension when you purchase that policy. And in that way, you either provide an income legacy to your spouse, or alternatively, you cover, even on a single life, a guaranteed period that income will be paid for. So it's certainly available, and therefore ensures that you're not going to be losing your capital when you pass away. Of course, these what we call death benefit options do influence the annuity rate, so one has to look at that carefully and ensure you find the balance. But certainly it is available, both the spouse's pension and the minimum payment period. Right, so we then get on to, I've spoken about the fact that you can buy our just lifetime income with profit annuity, our flagship product, on a standalone basis. But of course, what you now find in the market is this blended solution or hybrid. And I'd like to speak a little bit about how that works. So what I've got here on the screen is a table. On the right-hand side of the table, we've got the sustainable drawdown rates as issued by a CISA in 2018. Well, as issued by the regulator in conjunction with the CISA. So it's split between male and female over the different ages. And you'll see there that for the age of 65, a single life male sustainable drawdown rate is 5.5%. And as Shauib was saying, the assumptions that have been used there is that to ensure that the living annuity capital for a retiree is sustainable, with a 90-degree probability of being able to sustain the retiree right through to their life expectancy, which essentially is based on around 30 years, the maximum drawdown rate would be 5.5%. Now, if you look on the left-hand side, you've got our indicative just lifetime income with profit annuity rates. This is for the high grow option, lowest starting income, highest chance of increases. And you'll see the starting or indicative annuity rate is 8% for a single life male, which is considerably higher. So, and then of course, if you look at female, again, it would be 6.5 versus 5. And they say if you're looking at a joint life, you would take 0.5% of the lowest amount. So on the right-hand side, you'd use a 4.5% sustainable drawdown rate, which would compare to a 6% sustainable or not sustainable, a 6% guaranteed life annuity rate for a joint life. So you can see that the annuity rate or the guaranteed lifetime income that can be purchased with a life annuity is higher than the sustainable drawdown rate. And there's a very important point that needs to be put across here, and that is it's not magic. It's just that when you are in a living annuity, you're self-insuring, and therefore you need to plan for perhaps 30 years. So that's kind of the universal rule. Whereas when you purchase in a life annuity, we as an insurer are pricing based on the average, which means some people will live longer, others will die sooner, but on average, people live to 82. So if we only price into 82 on average, that's 17 years instead of 30 years, which then simplistically means we can start a person off at a higher starting income, 8% versus 5.5%, which means that you're going to get more bang for your buck. So if you take in your R1,000,000 and you want to try and buy the most income you can, which will sustain you and never run out, no matter how long you live and no matter what happens in the investment markets, then we would argue that there is a place for a guaranteed life annuity in a person's retirement plan because it gives you more bang for your buck. It gives you 80,000 Rand of income a year guaranteed as opposed to 55,000 Rand income a year. So this graph is an important graph illustrating that we do believe there is a place for guaranteed life annuities in retirement. However, we're not saying that a retiree should put all their money in a guaranteed life annuity. And that's where the blend comes in, because blending is an ability to combine the guaranteed life annuity with a living annuity. And our philosophy is that one should basically allocate the amount of money to the guaranteed life annuity that covers a client's essential expenses. So we're talking about food, accommodation, medical aid, those fixed essential expenses that have to be paid no matter how long they live and no matter what happens in the investment markets. And that's where there certainly is a place for the guaranteed life annuity. So what we've done is we've taken our product, this just lifetime income with profit annuity, and we've partnered with a number of living annuity platform providers. So for example, the likes of Allan Gray, the likes of Signia, the likes of Alexander Forbes, the likes of PPS. Those are platforms where if you purchase their living annuity, you can then inside that living annuity purchase our just lifetime income guaranteed life annuity as an investment portfolio option. So on the screen here, you have an example of a blended solution with the rules of the 2.5%, 17.5% applying to the living annuity solution. Inside the living annuity, you've got various portfolios, and a new portfolio that's now available is portfolio 4, the coral color, which is the just lifetime income. And it's as simple as doing a switch. So a client who's in the living annuity would effectively switch some of their money out of the portfolios they want to go out of into the just lifetime income portfolio. From a practical perspective, it remains a living annuity solution because what we do is we are going to be paying that guaranteed lifetime income into the living annuity. So we don't pay it directly to the client, we pay it into the living annuity, and that then is allocated by purchasing units into one of the portfolios that the client uses for their drawdown before the repurchase happens that pays the client their monthly income. So it's an in purchase in units, and then an out, which is a repurchase. And as a result of that, you have a solution that provides a more sustainable income for your clients. So the living annuity becomes more sustainable once you bring a guaranteed lifetime income into that solution. So it's not magic. So you are trading capital for income, but you've got the ability to buy tranches of guaranteed lifetime income as and when you want to. So you don't have to do all at retirement, as you know, in terms of the Income Tax Act. At retirement, you can split your money between a guaranteed life annuity and a living annuity, whereas after retirement, you can't. Which means if you want to purchase further guaranteed income, you've got to transfer the full amount of your living annuity out into the guaranteed life annuity. So this solution is quite useful and allows for dynamic planning where you can top up and purchase tranches over time. And also what's quite nice is the guaranteed lifetime income that's paid into the living annuity, it doesn't all have to be drawn down. So if the annuity rate is attractive and the client's on a low drawdown rate, that's another way of building up the capital in that living annuity, creating a high legacy benefit for your client. An important point just to emphasize here is the solution has been approved by the regulator. So the regulator has allowed various living annuity platforms, the ones I've mentioned, to include it as a guaranteed life annuity in their as an investment portfolio in their platform solution, and also allowed that the platform can continue to pay ongoing advice fees on that living annuity on the total asset value, which means the just lifetime income portfolio is included as an asset, and as a result, the client, the advisor continues to get the ongoing advice fee. And I think the regulator is happy with that because this solution provides sustainable income for the client. So as you know, with any guaranteed life annuity, there's no ongoing advice fee or commission. You're only entitled to an upfront commission. That would be the way that's the way it's structured for any standalone solution. But when you blend, when you wrap it inside a living annuity, the regulator is happy for the platform to continue to pay an ongoing advice fee. And then just last point, which I'd like to mention, is that the guaranteed lifetime income portfolio can even fit, if I just go to this slide, can even fit in a living annuity solution, which many advisors have set up using the bucketing system. So many advisors use a bucket system where they put the first 2 or 3 years worth of income into like a money market or cash bucket, the next 7 years of income into bond income funds and moderate equity, and the balance into a high growth or foreign offshore portfolio. And now you want to allocate money towards the guaranteed life annuity in the living annuity. What you see there is that each of the buckets have been filled up. So you see across from all the way from 0 to 20, the bucket has been filled up first with Julie before the remainder has to be utilized by the various different asset classes. So what we're saying is that even in an income bucketing approach, what you would do is you would just adjust the amount you hold in each bucket by taking into account the guaranteed income that's going to be made available from the just lifetime income product inside the living annuity. So it can even fit in, and as it indicates here, it is the cheapest way to match essential expenses. Last point is we do have a tool, which is a very useful tool. It's called Just Blend. And what it does is it allows you to work out what is the appropriate or best amount that should be allocated to the just lifetime income portfolio. So the tool allows you to move around with blending. Should you put 10%? Should you put 50%? What percentage should you put in? And each percentage then will give you a scenario which shows how it affects the client's income, as well as how it affects the legacy or market value of the living annuity. And this tool is available via the different platforms. So once you speak to your advisor, once you speak to Marcel, she will be able to make available this tool, which will allow you then, will assist you in the blending process. So that brings me to the end of the presentation. Thank you very much for your time, and more than happy that you contact me at any point in time if you have any questions on our guaranteed life annuity product. Thank you.
Thanks so much, Clive. Appreciate the presentation, and that brings us to the end. If there's any questions on the presentation, you can contact Marcel. And if there's anything specific that she needs to hand to us, either myself or Clive, we can definitely do that if you need to get into contact with us. Thanks so much again, and we will see you for the next one.